Thank you. Welcome to this webinar. I'm delighted to have Ali Shafqat, the CEO, and his colleague Alex Norton, the associate of Qbera Capital. Ali has spent more than 20 years in financial services in London, Dubai, Pakistan. He's spent a lot of his career at HSBC, and now he's the founder of Qbera Capital. And in this today presentation, he and Alex will talk about raising capital, especially for social impact project, which I think is a very interesting topic because especially in the context of Pakistan, where a lot of sectors which do require investment and where there is lesser capital available are all the sectors which can come under the category of social impact, sectors such as agriculture, infrastructure, education, healthcare. So I think it's very, very relevant. And I'm personally very excited to hear what Ali and Alex have to say in this webinar, because I think it's a niche topic and not many people in the financial world have too much exposure about impact funds, ESG, what do investors look at, and how can Pakistani companies raise finances from these kind of investors. My name is Ali Khwaja. I'm the chairman of KASB Securities. It's a stock brokerage investment bank in Pakistan. Our app K-Trade is used by more than 130,000 people to invest in Pakistani stocks. So with that, Ali, I've already seen your presentation and I know it's extremely interesting. So I hand it over to you and Alex to run us through your presentation and tell us more also about your background and also your views on how can we raise capital for social impact. So over to you, Ali. The presentation will be for 30 minutes and then we'll be open for Q&A. Like with other webinars, the format for Q&A is please write the questions on chat, and after Ali's and Alex's presentation, I'll put the questions to them. So thank you.
Thank you very much, Ali. Let me put up some slides that we have put together. We thought it would be easier to put it up, given that you're right in saying that it is a bit of a niche topic and often a bit misunderstood at the same time as well. So I think we'll kick off. So as my name is Ali Shafqat, I'm CEO founder of Qbera Capital. I will give a quick introduction about the firm and myself, but first of all, I would like to say a big thanks to Park Launch team for organizing this session. I think the team is doing a phenomenal job in connecting Pakistani talent across the globe, and I'm really happy to be part of it. And I think kudos to the team for taking this initiative and following it through and taking it to the next level and becoming better at it. So the way we're going to run it, there are two sessions today. So I'm going to talk about the sustainable capital for emerging market, and it's a broad topic, but we will try to cover some specifics around it as well, especially on the development financial institutions and impact capital and how it could be relevant for Pakistan as an emerging stroke frontier economy, depends how one looks at it. And then Alex Norton is going to take over from me. Alex helps a lot in Qbera Capital with the early stage investing that we do, both as principal and also as advisors as well. So Alex is gonna help me out with that particular session. Just very quickly, I think one of the reasons why we have picked up this particular topic is that in the past 3 years, since we have been heavily involved in a number of capital raise projects across emerging markets, especially in Africa, India, Southeast Asia, where we have raised sustainable and development capital as part of the funding mix of corporates across the various stages of their life cycle, starting from the early stage to kind of multi-billion-dollar commodity clients. I've realized that it's something that a lot of corporates don't necessarily make the most of it. The companies that we have supported and continue to support have kind of varied in size, as I mentioned, and at different stages of life cycles. So what we have seen in the last 3 years, that in impact and developmental capital, there is pretty much everything for everyone at all stages of capital. And especially in our experience, we have not seen many Pakistani companies being active or availing this kind of capital as much as we have seen in other emerging markets and places which are comparable places like Indonesia, Nigeria, Bangladesh. India, although it's a larger economy, but I will still compare that with Pakistan to a certain extent, given that it's part of South Asia. And so today's, and when we have spoken to various DFIs and impact capital and asked them the question in terms of why they don't do much in Pakistan, I think the general answer that we have always get is that we would love to do more in Pakistan, but we don't often find bankable opportunities. So one of my objective today is that that we make or introduce this form of capital or these pockets of liquidity that the people joining this forum, either as a startup or representing corporates or just as an information, become aware of, and this alternative capital that they can use as a form of funding mix. So just on this note, quick introduction of Qbera Capital. But first myself, so as Ali mentioned, I've spent most of my life in HSBC. I worked in the UK, I worked in Saudi Arabia, I worked in Dubai, I worked in Pakistan for a couple of years. And for the last 3 years, I'm based in Pakistan, so in the UK. So Qbera Capital is an investment management firm. We have got two lines of businesses. One is very classic corporate finance business, investment banking, some people call it, where we raise debt and equity for corporates. And also we are active in merger and acquisition. And the sectors that we cover are largely energy, logistics, food and agri, telecoms, metals. So it's a wide ranging, but very specific to our backgrounds, the people who have come together in Qbera Capital. The geographies that we cover is Africa, Indian subcontinent, Middle East, Southeast Asia, a very emerging and frontier market focus. We have got office in Johannesburg, where we cover mostly sub-Saharan Africa. We have got a small presence in Dubai as well, where we cover Middle East and South Asia. And in terms of the activities that we do, as I mentioned, in corporate finance, we do advisory, the debt and equity, and also the impact advisory, which is the topic of discussion today. The second part of our business is investment management, and within investment management, we have got a investment product that we manage. It's a discretionary portfolio that we run. Again, very heavy ESG focus. We target SDGs 1, 2, 8, and 12. I will explain it to you what these SDGs are a bit later. And again, very emerging market and frontier market focus is a short-term debt product where we provide working capital to companies in emerging markets. The other interesting investment product that we are planning to launch is a longer-term debt product, and that particular product will target renewables and agricultural. And again, it's emerging market and frontier market themed product. Just a few things. We on the ESG side of things, we have got strategic alliance with a very large firm called Stewart Redqueen. Is a Dutch-based ESG consultancy which has been in existence for about 20 odd years, and they have been one of those outfit which did the ESG work before ESG phrase was coined. From renewable side, which is another heavy focus for us, we have got an alliance with Schneider Electric, specifically on what we call corporate and industrial opportunities, where there is an energy transition story, and we help the corporates to embark on that journey where they bring in renewable into their energy mix. I think on the concept of sustainable capital is rather very simple. If I was to define it, I will say it is about delivering positive social and environmental impact alongside investment returns. And this has been increasingly common, at least from a European context. Maybe in the US has lagged behind a little bit on this particular concept, but the European impact funds and general European market have adopted this in the last kind of, I would say, 5 to 7 years. and they've really taken a lead in making it a core part of most of the portfolios, whether they are asset manager or development financial institutions, or even in certain cases, the individual portfolios as well. And I think one of the phrases which I always mention, and I really like it, is from Saka Nusseibeh, who's the CEO of Federated Hermes, about the sustainable capital, and in his paper is called The Why Question. And the way he put it is saying economics has developed as a science, and conveniently forgetting its roots in political philosophy. Unfortunately, that science is severely dated, and the functioning of the global capital markets has become separated from the real world. And to a certain extent, is very true. I think if we look at 80s, 90s, and 2000, and people who have studied economics will agree that it's been very much a single focus, bottom line, profitability, kind of what people have gone after. But I think since the financial crisis of 8 and 9, there are various other concepts that have emerged, and a sustainable and development corporate capital is one of those, which is still in early days, but I think it's become more of a necessity than a good thing to have. Just a few things about the sustainable investing. I think one of the things I was chatting to Ali about before this session started, that this concept is often confused. Not just confused, I think there's still there is not a huge amount of standardization that has happened on this particular topic, and in North America, perhaps people will recognize it differently. In Europe and in Asia, there is certain level of standardization, but still a long way to go before we see a standardized approach across the world. But generally, the sustainable investing, I think is super relevant to emerging and frontier markets generally. Because I think the impact that one can achieve via the capital that they deploy. And when I talk about the capital, guys, the capital can be in all forms and shape. The capital could be equity, capital could be debt, or any other form of hybrid within debt and equity space that one can look at. So the capital is a very kind of wide-ranging phrase that I'm going to be using today. So the companies who have adopted that approach look at it differently, and it's partly driven by their shareholders and stakeholders as to what they want to achieve from the money that they give it to, whether they're asset managers or to family offices or on a personal investing side. So there are four general ways of looking at it. So one is a very simple one: exclusion. And exclusion literally means, and I think given that a lot of people who are in this session are from Pakistan and they follow Islam as a religion, so exclusion generally means the sectors that one doesn't want to invest in any form or manner, or either they want to relate. And this could be, for example, for a lot of Sharia compliant investments, it could be alcohol or gambling or any of the sin sector which are banned. But over and above, there are some preferences or some themes that certain asset managers and their shareholders or stakeholders want them to follow. And a lot of those themes could be climate related, or a lot of themes could be social related. So generally the way the investments are created or the product are created is a simple exclusion of certain sectors or certain religious beliefs or certain ethical views. And perhaps that's the kind of easiest is a wrong word, but it's a first stage of investing for purpose, you can say. Moving into slightly more kind of deeper sustainable investment, the second part is where the companies or the people is saying, okay, we're going to positively screen companies. And when I say companies, again, it could be stocks, it could be companies giving debt out, or it could be countries, or so various forms of investment product. They apply a positive screening for that, which basically means that one of my investors could come to me and saying, Ali, we are very conscious of the GHG emissions, and I only want to invest in renewable sectors, or only want to invest in agricultural sector. And that provides us a kind of a baseline where we screen their preferences and pick up whether the equities or the companies for the debt side which conform with their preference. And that is, you can say a certain level of theme is attached to that, but generally is a positive screening, as we call it in the industry. The third level is slightly going further deep into incorporating or integrating the ESG. ESG is environmental, social, and governance. I think it's quite a common phrase, so hopefully people will recognize that. So the third level is the ESG integration, where there is a aspiration for the capital to bring about a certain amount of positive using their capital. So it's less passive, but slightly more active, where there is a certain expectations from the portfolio company. Let's say if we talk about the private equity houses or talk about the venture capital fund, they could have a certain SDGs or sustainable development goals that they can follow, and they will bring that into their specific strategy, investing strategy. And these are then incorporated, and these are then measured and reported back to the investors. So as an asset manager, or as a people or custodian of the funds, it's the responsibility of the investment managers to measure those ESG targets and report back to their investors. The fourth one, which is kind of a lot more deep, I would say, is impact investing, which target very specific and narrow range of outcomes. And that could be, for example, the kind of one good example of impact theme can be education in Africa, for example. That's a very specific theme that a certain investor can follow. So impact investing activities, I usually pick up a certain theme, and that particular theme could be specific to a certain geography. And jobs could be another one, or youth jobs can be another one, that if I want to use my capital to create youth jobs in frontier markets, then that capital can be deployed for that particular theme. Without spending too much time on it, and I'm conscious that we're going to be sharing this presentation with the participants over here. Pretty much what we have said is that this is the transition going from a very traditional investing that perhaps 95% of us today are familiar with, where a lot of ESG matters are perhaps not even considered as part of our investment strategies, both as an individual or if we are working for investment managers or investment houses. But this is generally the kind of some form of standardization that's come about, and this particular slide I've taken again someone that we follow very closely and work very closely with is Federated Hermes International, which really have been at the forefront of incorporating ESG into their investment themes across all products, right from the venture capital, private equity, to all the way to fixed income space and equity space. Again, not spending too much time on it, but I think this is a great slide which pretty much differentiates what are the different type of impactful products various type of investments lie within. I think the question which always get asked is, first of all, why would people do that? And the second is that who follows these kind of sustainable and development goals, and where does the capital lie? I think emerging and frontier market for the last 10 years have hugely benefited from the ESG investing generally. Because if most of the people hopefully will be familiar with the United Nations Sustainable Development Goals, which are the 17 goals that most of the world leaders have agreed that they have to do something about up until 2030, and sets very stringent targets. And to a certain extent, the Paris Climate Agreement and the Addis Ababa Agreement was part of that. These SDG have become the cornerstone for most of the thought process, at least, or the activities that most of the capital providers are following these days. Personally, I've seen it more and more in the last 3 years, and I've got no doubt in the next 10 to 15 years, we will see more of these targets or capital being linked to those targets. So coming back to sustainable and development capital players, development financial institution are the kind of most obvious ones that perhaps as Pakistanis we are very familiar with, because we have heard the name of World Bank and IFC and Asian Development Bank since perhaps we were very young, and they've been very core part of the Pakistan economy for a number of years. So the development financial institution comes in various shapes and sizes. To be honest, there are tens of development financial institutions and different kinds. Some are more regional, some are more local, some are more global. They could be bilateral or they could be multilateral. Bilaterals are, the examples of the bilaterals are the likes of FMO, which is a Dutch development financial institutions. The example of the multilateral would be International Finance Corporation, or IFC, which is a global institution, and the local development banks, like in Pakistan, I think there is an Agricultural Development Bank and so on and so forth. So these are examples of the local DFIs. I think often one of the things that we have seen that companies and companies, especially operating in emerging and frontier markets, often are not aware of these players. As part of our work with these companies, we had some specific successes in the last 3 years in bringing about capital from DFIs of various sort. In terms of the market instruments they use, is debt equity. They do pretty much everything, and a lot of DFIs have evolved in the last 10 years or so. So it's a one space that I will specifically talk about for 3-4 minutes. But before I do that, the other forms of sustainable development capital is philanthropic. And again, there has been a significant shift in philanthropic capital, which is now becoming, to a certain extent, what they call it commercial philanthropy. And philanthropic capital, the example would be, again, the household names, I would say, would be Gates Foundation or Rockefeller Foundation and Skoll Foundation and likes of those. But a lot of these philanthropic organizations have set up commercial philanthropic arms as well, which again is a very interesting pocket of liquidity that especially the emerging startups in frontier and emerging markets should definitely reach out to. And these are the people which are looking at commercial philanthropy in a manner where there is a certain amount of discount applied to the return expectations, but also they would do a certain amount of philanthropic capital. The private funds are the likes, what I mentioned, the likes of the Federated Hermes Capital and everything. I mean, these guys they stay commercial, but some of them are not for profit as well. This not-for-profit impact funds, usually you would see them in Europe. There are a certain amount of not-for-profit impact funds in the US as well, like so Root Capital is a great example for someone in North America they might be familiar with. But again, these kind of three type of capital, I would hugely encourage the people who are looking to start up the business or looking to fund their business, especially in Pakistan. They should bear that in mind when they are evaluating raising funding for these kind of things. I'm a bit behind, so I'm going to rattle through some of the stuff. This page is important because it's possibly the most kind of recognized picture in planet these days, which is the 17 Sustainable Development Goals that the UN announced a few years ago. And just to give you the scale of this particular segment, it's not as big as the conventional capital, without a shadow of doubt, but still it's not insignificant as well. I think as per the report by Prekin, which is quite a recognized publication, the total impact capital commitment, at least globally, is touching about 2 trillion. And it may sound kind of small for the people who know the likes of BlackRock and Blackstone and everything and their asset under management. But I think if we put things in context, that a lot of that goes into emerging and frontier market, I think that's quite a significant numbers. And some of the emerging markets, including Brazil, India, Indonesia, Nigeria, Bangladesh, China have hugely benefited in the last 20 years from this development corporate capital, whether it's in infrastructure or ports or energy or social or affordable housing. But again, it's a theme that unfortunately I don't see Pakistani companies or even Pakistani state-owned enterprises use this capital effectively at all. So just a few kind of comments on the development financial institutions. So we talked about the DFI world. It can be local, regional, and global. Over here, specifically, I've picked up development financial institution, which I know operate in emerging and frontier market, and a lot of these also operate in Pakistan as well. So in terms of development financial institutions, they are not they don't follow a standard theme. A lot of the DFIs will have a certain mandate. That mandate could be driven by countries or geographies. That mandate could be driven by the sectors. For example, some will focus more on agri and renewables, or some will be a lot more generic and global. One of the things which often people don't know about, that within the development financial institutions, they pretty much take care of most of the products these days. So traditionally, the DFIs used to be known for providing debt capital for infrastructure project, etc. I think the evolution of development financial institution, if anyone has followed that, has been very interesting. In terms of the instruments that we are seeing this development financial institution kind of using these days is debt financing across the capital spectrum, ranging from senior secured debt, which has been the traditional route of financing, all the way to mezzanine finance and equity convertible debt. Even some of the development financial institutions have specifically set up the teams to look at the early stage companies in emerging and frontier market. And again, something that I'm aware that some of the Park Launch members are from early stage, are entrepreneurs who are at early stage of their ventures. And that's another pocket of liquidity that I see a lot of people are not familiar with. They have got deep pockets, they have got good risk appetite, and they have got focus for frontier markets. So I think something that people should definitely use as much as possible, because I can tell you from our experience, a lot of countries are using that capital for their benefit. The last thing on the development financials, not all of them, but a number of DFIs also have got a private equity arms. People like CDC over here, which is the UK, have got a very strong private equity arm. Norton, FinFund, they have got private equity arms. And again, most of the investments that they do is in emerging and frontier markets. I think this slide is more as a reference slide, reference in a sense that the scale that you're seeing is useful, in a sense that we are talking about a 2 trillion plus kind of liquidity in this space, which by no means is insignificant. And as you can see, that emerging markets at the bottom right graph, the emerging markets takes a lion's share of this impact and sustainable capital. Now, on the ESG themes, so as I mentioned, the ESG is environmental, social, and governance. So these are the broad themes that most of the DFIs and the sustainable capital people will follow. Not necessarily only these, but these are the broad themes that will follow, and a lot of them will have some kind of sub themes within those. Now, the technology, which I think a lot of people on this forum have come from the technology background. If you overlay everything that you do over here with some form of technology, that is very applicable for most of the DFIs and for impact fund. I know there is a really great Pakistani startup in Agtech space that we are familiar with. There is a there is an energy efficiency player that I spoke to via this forum. So I think it's quite relevant for this forum that a lot of the tech startups that I've come across via this forum will take one or two of these boxes. So again, something that we should be aware of, that these themes means that if your product or your company is in these sectors, then the development or the sustainable capital is quite relevant to you. Now, another misconception about the development capital or the sustainable capital is that it's concessionary capital. Not in all cases. As we've seen in the previous slide, that it only become a concessionary financing, whether on the equity side, on the debt side, if you are dealing with very specific philanthropic kind of commercial organization or the impact capital. The idea is that you can still achieve a commercial return by integrating ESG effectively in your portfolio and your portfolio company. This is how it comes together in a lot of cases, that these themes which are at the bottom of this slide, and when you start to link it up with the United Nations Sustainable Development Goals, and I'm sure a lot of the companies that you work for or you have set up, or the tech startups, could potentially fit into these boxes. And once we identify which SDGs they cover and what type of themes that they cover, it becomes easier to target those specific capital pools that are accessible to the companies in Pakistan. Maybe a couple of minutes on the private impact investors. So these are not to be ignored as well, because within Asia, within Europe, and within US, a lot of the conventional funds have also following certain impact themes. And again, they are still maturing, but nonetheless, if you look at the average fund size of those, they may not be huge, but in context of emerging and frontier market, I think these numbers are still quite significant. So again, to reach out to them, again, but one of the I'm expecting the question in terms of how do we identify and how do we reach out to them. I'll cover that a bit later in the Q&A session. But I think given it's not easy generally. You really need to do a lot of research and speak to the people who are active in that space to be able to identify and plug into that, because the demand for this capital is massive from frontier and emerging markets, and these guys a lot of the times are inundated with the request for capital. But again, we see a fair bit of that, and unfortunately, not many Pakistani companies are there. So very quickly, some of the impact capital providers, again, some of you guys may or may not know about these guys, but very quickly going through. Bamboo Capital Partners is a relatively decent one. I think their size is more than $500 million now. Finance in Motion is another one. I've only picked up the names, by the way, which are active in South Asia. There are many other names who have got maybe Latin American focus or Southeast Asian focus, but these capital providers, again, someone who is looking to raise capital and someone who has got a product or a startup that ticks some of the boxes with a thematic investment, they should definitely consider reaching out to these guys. Leapfrog, Calvert is another big name. So Leapfrog is one of the names that we work very closely with, and it's a fantastic outfit. They focus on the private equity side. Calvert is a US name, which is again quite active globally. So some of these names, and again, please reach out to us if you need anything from these names. We have been working very closely with them in the last few years and trying to promote Pakistan as much as possible. So if absolutely feel free to reach out to us. I'm running a bit behind, so this slide is purely about giving you some of the large fund managers who are looking at the ESG thematic investments. And you will notice there are some big names there: Investec, Jupiter, Bailey's, Fidelity, there are Hermes. They're all large funds who are following certain kind of ESG investing. So coming back to my point that this ESG investment will only increase, and I think we are seeing the cumulative growth is almost about 70% in the last 3 years on ESG investing. The last on my list is how Pakistan has fared behind simple green loans or green financing. So this slide we have put together just to give you an idea that in the last 12 months, including the corporate loans and the bonds that have been issued by the country, if you look at Pakistan, there have been only 14 issuances compared to 450 in India. And the amount that were raised were quite small. So I am aware that the State Bank issued a green financing guidelines about 3 years ago, but frankly, we have seen a very little take up from the corporates in Pakistan. And I think that Pakistani corporates can make a lot more use on the green, social, and sustainability bonds as a form of a growth capital. And again, if you look at some of the green and sustainability bond issuance in emerging markets, this is like almost 300 billion has been raised in 2019. I think Pakistan made up about 0.02% of that. So that's kind of a like quick rattling from my side on this. Just to summarize, I think from a frontier development and frontier market perspective, I think Pakistan is Pakistani companies should access more of developmental and impact capital. That goes without a shadow of doubt. And I know IFC is active, and some of the VCs in Pakistan who are also in this forum as well are using IFC money and some of the impact capital. But I think the companies or the companies who are in late stage or mature companies, there is no reason why they should use this form of capital bilaterally with them as well. So that's it from me, Alex. My sincere apology that I'm not going to leave you much time on that, on your venture funding, but I think if we run 5 minutes kind of late, that should be okay. We should be able to capture a lot of questions.
Hi everybody. Looking forward to talking to you today. Thank you for having us, and thank you for your session earlier, Ali. So as briefly alluded to earlier, I'm going to quickly cover venture funding and alternative sources of capital for startups and later stage businesses that particularly are in emerging or frontier markets, or perhaps based in the developed world, but their product focus is emerging and developed markets. So some of what I cover here might be a little basic for some people if they're heavily involved in the VC side, but as I wasn't sure exactly the makeup of the audience, I might be covering a few things at a very high level. So as startups grow from kind of idea stages to maturity and finally a successful exiting business, valuations change and sources of capital change throughout. So at the kind of very early stage, we have pre-seed / seed businesses, and at this stage, you might have an idea. No team, or you might have an MVP or not much at all really, and you're just testing the market. And here you can raise money from friends or family, almost always equity, up to somewhere around $50,000 perhaps. And this allows you to build your initial product. Perhaps it has a little traction, and perhaps you're starting to build a team. At this stage, or sort of late seed stage, raising anywhere up to $3 million, again, normally almost equity. And the participants in these rounds tend to be angel investors, friends and family, micro venture capital funds, and more recently, crowdfunding platforms. Then moving on from there, you've got your Series A level. So at this point, your business has been running for a little while. You've probably got meaningful revenues. You may not be profitable, but you have a team and a fully fledged business. Raising additional capital to expand your business, heading towards growth and profitability. At this stage, typically raising up to $15 million via equity or convertible debt. Funders tend to be accelerator programs, super angel investors that write large tickets, VC capital, and more recently, corporate venture capital as well. After Series A, you have Series B, Series C, and an infinite number of private capital rounds after this, but these are all normally for scaling up, building out, and expanding your product. There may also be for exit preparations. So before a trade sale, an IPO, or M&A process, businesses may raise money to bolster certain parts of the business in anticipation for this sale. So next slide, please, Ali, if you could. So before we move on to venture debt, which is the key topic that I'm going to talk about today, I'll quickly gloss over valuations for mid-stage and late-stage startups. So between 2006 and 2020, early stage angel and seed level businesses, median valuations have kind of stayed flat. Perhaps they've tracked inflation, but they haven't really moved. However, early stage VC and late stage VC valuations have increased significantly over the last 15 years. The reason for this is largely a function of companies' ability to raise capital. So there's more and more private capital on the market that is interested in investing in venture capital and tech type businesses. So as Ali said, impact and DFI funders, either on the fund of fund sides, investing into VC firms, who are more interested in looking into emerging markets, or simply because there are more players on the market. This creates pricing pressure, more investments are done, more startups exist, and as a result, valuations tend to get higher. So valuations, everyone says, high valuations is normally a good thing. We read about, in the news every day, you have startup founders that have made, tens or hundreds of millions of dollars on paper with some crazy valuation. And this is fantastic when times are good. Because the main reason people invest in and end up being part of businesses is to achieve a commercial return. But particularly now, I think it's important to look at the kind of darker side of high valuations. So we have to remember that investors of all shapes and sizes aren't immune to the effects of an economic downturn. So particularly we saw this in April and March, where asset classes across the market fell. So public equities, real estate, private investments, everything fell in value and investor activity decreased. And this meant that less follow-on capital was available from investors into their portfolio companies, or for other companies to be raising more money from private markets. So the COVID crisis in particular has left us globally, not just in emerging markets, with companies that are perhaps exposed to incredibly high valuations, but without the growth or the revenues or the consumer base to support these valuations. So WeWork was a prime example. So it was before the COVID crisis, but it was an example of a company with an absolutely insane valuation that was not able to raise follow-on capital through public markets. So as a result, the key theme here is that diversification of funding is required, and we'll introduce a couple of different methods for that. So next slide, please, Ali. So key theme here that I'd like to talk about is venture debt. So venture debt is something that's been around since the beginning of time, really. It's a lesser known, perhaps more esoteric way of funding an earlier stage business, but essentially it's an option to increase a business's runway without diluting the founders or the early investors much, or if at all. So venture debt is a special type of term loan, and it's cheaper than raising equity normally, especially now when interest rates are at all-time lows. And again, I mentioned inflated valuations are making it incredibly difficult for companies to raise money without going through down rounds. So as you can see, venture debt activity has increased between 2016 and now at an incredible rate. The data for 2020, which is from Preqin, is from March to April this year. So I would expect year-end data to show us that venture debt deal activity is still on the rise, maybe even higher than it was back in 2019. Next slide, please. So the case for venture debt, why should people use venture debt, and what kind of businesses does it fit? So it absolutely does not fit every business. It's important to understand why and how to use it as an effective financing tool. So typically you'd use it to extend your runway for any number of reasons. The main ones are extending your runway to a better valuation, or extending your runway to achieve profitability. So as we know, startup funding rounds don't always happen in a timely manner, and there can be hiccups along the way. So perhaps if you've raised your Series B, but you haven't quite hit profitability, and you want to raise your Series C and you want to be profitable, because that will unlock a whole load of additional liquidity pockets, but you're not quite there yet, venture debt can be a fantastic tool to get a little bit of extra money in the business without diluting the shareholders and the founders too much. And then finally, it can be used as sort of like an insurance product. So as we saw again in March and April of this year, large corporations, so hotel chains, airline businesses, drawing down on their revolving credit facilities and other debt facilities in order to keep them funded through perhaps a difficult time. So either if you see a tricky time ahead, for example, the COVID crisis affecting your particular line of business, you might look to a debt funder to provide you with some sort of backup. Or if you're gearing up for a large equity round or an M&A process, these can take much longer than anyone could expect. And in order to extend your runway, just in case equity funding is delayed, you may look at venture debt. So it can be used for a wide range of things. So growth capital or acquisition financing, so the same way you would use traditional equity. And it can also be used for receivables financing or equipment leasing. So for some kind of capex heavy businesses where you may require investment in telecom infrastructure or even machinery, it makes sense to lease this equipment where possible or financing it with debt rather than raising a huge equity round to fund all of these capex projects if you're not necessarily profitable or don't have the cash flow to fund it yourselves. And then finally, increasing the efficiency of a funding round. So we read about startups and later stage businesses raising money all the time, 50 or even hundreds of millions of dollars. But it's important to remember that typically this isn't always equity funding. So there'll be normally a mix of debt and equity, depending on who the business is and who the investors are. In terms of who's typically involved in venture debt, apologies if I'm running through this a little quickly, but you have banks and institutions set up like Silicon Valley Bank specifically to finance these businesses with debt. And then you have DFIs, as Ali discussed earlier, guys like FinFunds and similar, who will fund later stage businesses with debt and or equity at the Series B, kind of Series C level when they have alignment with impact and other SDG targets. And then finally, classic venture capital funders, and Justin Howard's here as an example, that do equity and debt tickets to their portfolio companies. So how does venture debt differ from typical corporate debt? So if I was a banker lending money to a business, it's common to look at a business's coverage ratios, so debt service cover, interest coverage ratios, or basically how likely is that company to be able to pay me back my principal with their own cash flows. Startups are a particularly interesting animal because most of them, maybe not most of them, but a huge number of them are not profitable. They burn huge amounts of cash, and particularly with software businesses, they have tiny asset books on which to lend against. So venture lenders, unlike commercial banks, will typically look at the fundability of these businesses. So how likely are they to be able to raise money in the future, and how likely am I be able to get, I as a banker in this example, to be able to get paid back. Moving on to pricing. So I've said that venture debt is non-dilutive. That's not particularly true. It's essentially non-dilutive, but many lenders will ask for warrants between 1 to 2% of the business. So warrants in the most basic sense are options that allow a lender to take an equity stake and buy an equity stake in that business for a very low price. So if I was lending 3-year money to a business, I may take a 1% equity warrant in that company in the hope that one day, if they ever exited, I would be able to exercise my warrant, purchase part of that company at a discount, and then sell it to whoever the buyer was in order to capture some of the upside in that business's growth. Valuation is not required when financing a company with debt, which is incredibly important, especially when the economy perhaps has taken a turn for the worst. In terms of interest rates and pricing, it's a huge range. You could be paying anywhere between 5% for perhaps a receivables or invoice factoring facility, all the way up to 20% for a longer dated term loan, up to 2 or 3 years. And interest payments on this may either be classic interest and principal payments that are monthly, or typically if businesses have negative or very low cash flows in the first year or two of their business plan, all the interest and all the principal payments will be rolled up into a balloon payment at the end of the period. Next slide, please. So moving back onto so the key theme: raising money, focusing on emerging and frontier markets. So as we've explained, and as everybody knows, the COVID crisis has dramatically altered the startup funding landscape. So the humanitarian and economic impact is severe, and particularly in emerging and frontier markets, perhaps we haven't seen the full extent of the damage. And as a result, startups and other larger businesses will fail to grow. Some will go bankrupt, and liquidity will dry up. This is because when people turn risk off, investors tend to exit emerging and frontier markets as they're perceived as being the most risky. So in the last 10 to 15 years, we've had incredible growth in emerging markets, where we have people having more and more access to financial services, data, internet, smartphones, where some European or American-based PE and VC investors have kind of dipped their toes into emerging and frontier market venture funding. And as Warren Buffett said, I quite like the quote, "It's only when the tide goes out do you really realize who's swimming naked." And this is exactly what's happened, where a lot of VCs have exited the market because perhaps they didn't have a complete understanding of the areas in which they were playing. And a lot of this capital has essentially left, particularly in emerging markets. So a crisis isn't always terrible. As we saw in 2008, multiple unicorns have popped up over the last couple of years, the likes of WhatsApp, Stripe, Uber, Gojek, a whole host of other people. And there's no doubt in my mind, or I think anyone else's, that many of these new unicorns will be born in emerging markets. But of course, everyone knows that they have to be funded. And if what I've just said is true, where traditional private equity or venture capital funding is less and less available, we have to default over back to impact and DFI and philanthropic funding that Ali has spoken about earlier. So as we know, impact capital is typically more sticky, i.e. it doesn't fly in and out like other hot money. It's there in order to deliver world-changing benefits and a positive impact on people's lives, not just commercial returns. So by definition, we would expect all this capital to stay during the hard times and in fact in the good times. However, accessing these pools of liquidity requires a very deep understanding of the market. So a lot of these funders might not publish the fact that they're looking at, they might not look at venture funding. Their website might not say any of this, but you need to have an understanding of who plays in the market, who is funding these investors, and what they're looking for in terms of impact and SDG alignment. And so next slide, please, Ali. So let's say you're trying to access some of the impact and private capital that we've both discussed earlier. Here's a sort of a quick checklist on some of the things that one might look for or one might require as a funder. So the main one is a group information memorandum. So typical pitch book of a business covering all aspects of the business. So structure, history, operations, team, and forecasts. Everyone will ask for this. Perhaps a bit more interesting or a bit differently is some investors look for ESG or sustainability policies, impact presentations to demonstrate how these businesses are actually delivering a positive impact, or how they're measuring it and ensuring that they're aligning with the goals that these investors have been set by, in fact, their investors. So looking at debt funding from commercial banks or some DFI lenders, they will require quite a deep dive on some of the ESG and sustainability policies that a business might have, and a bit more information that may be in a separate impact presentation. Moving on to group financial model. So everyone asks for a financial model from the very earliest stage of a business all the way to an IPO. The earlier the business, it tends to mean the more unreliable the financial model is. You'd never expect a financial model to be particularly indicative of how fast that company would grow, but it gives investors a good example of how management is thinking and how the key elements of the business work. So you'd expect to see in a financial model not just revenue forecasts, but also full three statements, so income statement, balance sheet, cash flows, as well as demonstrating how you could stress this business through various scenarios. So if you weren't growing at 10% a month or 15% a year, what would happen if you lost certain parts of your market? And following on from that, how would that affect a business's ability to service their debt payments if it was a business that had taken out venture debt? So a very key thing to look at, and financial models can be incredibly complicated, but I think as long as you have the checklist of things that institutional level investors are looking for, they tend to be quite happy. So next slide, please, Ali. So conscious we are really running out of time now. So covering exit routes very briefly. So there are a wide range of exit options available for mature businesses around the world, but particularly here focusing on emerging markets where public markets might not be particularly deep and local markets can't support a large IPO. M&A comes in kind of mainly two shapes or forms. So VC to PE M&A, where private equity firms are buying startups directly out of venture capital firms. Some of the key considerations here are that typically VCs look for revenue, consumer growth, but a lot of these hardcore PE players that are acquiring these businesses have a strong focus on EBITDA and profitability growth. So for some businesses, this is a bit of a change in strategy and something that they have to consider. There also may be the use of leverage in the acquisition, which could stress the balance sheet of the startup somewhat. And then finally, management fit. So depending on who the PE firms are, either they may eject the entire management team, or they may keep the management team, or any combination of the two. Trying to decide if the management has a strong fit with the buyer is something that has to be really thought about here. And then finally, an exit from a PE sale could take a significant amount of time. So sometimes it's required that the management team stay with the business for 2 or 3 years and vest out over a period of time. This could be the same with M&A to a strategic buyer. So typically you'd have job losses when you have M&A from a strategic buyer, as there'll be overlap in a lot of the job functions. But management still may have to stay with the business to ensure the post-merger alignment process. And then, of course, you've got classic IPOs. They come with a whole host of problems and benefits, but typically an IPO, you're selling a minority stake of the business. There's a very strong quarterly mindset, which is something different for management teams that have kind of lived year on year, where your share price is public and all your financial reporting is public. So there's a strong focus on day-to-day management and pleasing of shareholders, rather than sometimes the long-term growth of the business. And this can use up huge amounts of executive time. So definitely something to think about. Next slide, please, Ali. So focusing finally, particularly on private equity. So I guess a subset of the table I had on the other page, particularly because IPOs aren't always a viable exit route, and not many companies even make it to IPO. They tend to be bought out if they're successful at PE stages or later stage M&A. With the number of PE buyouts of startups over the last 20 years, has grew at an annual rate of around 18%. So this is huge when compared with a growth rate of only 10% for all buyouts of all types over the last 20 years. So it shows that there is a huge market for PE buyouts at the moment. And in addition, over 20% of all PE-backed startups have exited to private equity in the last 5 years. So this is versus a 2.5% rate back in 2000 or the dot-com boom. So it's an example how the funding market has changed, but private equity buyouts and M&A is something that is particularly important, I think, for emerging market businesses when local markets aren't particularly deep. So next slide, please. So I've quickly, very quickly rattled through the kind of venture debt funding and access to different pools of liquidity for businesses. In the Q&A section, happy to dig deeper into any of the things I said. But again, we'll share the presentation. Of course, you can read a little more into what I've said. So just finishing off, I thought it'd be good to kind of demonstrate, give a list of what Qbera has done. So as Ali said, we're active across the entire kind of growth cycle of businesses, from very early stage startups through to much later stage M&A or pre-IPO equity businesses, across agriculture, oil and gas, energy, and all kinds of tech startups. So yeah, that was hopefully useful for people, and sorry I had to rush through everything quite quickly.
Thanks, Alex. I think I just realized we have picked 2 very large topics for 1 hour. Ali would agree with me.
But this was a very interesting presentation, so thank you for that. We have had loads of questions, so I'll just quickly jump into the question, and I'll club a few together just to, sure, in the interest of time. There are some questions that which sectors do you look at? Do you look at EdTech? Do you invest yourself as well? And you have already spoken about it, but perhaps this slide, which is up there, how Qbera can help. So maybe you can talk a little bit about that.
So for the startups, there are two ways. So the first and foremost is that we don't have our own venture capital or the equity fund at the moment. So most of our business is helping the startups, or we call them early stage, or in certain cases late stage, to take them to certain pockets of liquidity and matching them to the right type of liquidity pool, especially where there is a very strong impact themes. And agri is one that I personally have got a very kind of long experience in that space. And agri and food, I club them together. And then certain part of my team are very strong in telecoms, for example. So the way we work is that if there is an opportunity that we feel that the pockets of liquidity that we have got really good access to, especially from the ESG investing perspective, then we work very closely with these startups across the life cycle, to be honest, and then make them help them to raise capital, whether it's equity or debt.
And what about EdTech? Is that a sector you look at?
I wouldn't say we are expert in that, frankly. So I think there is a bit of we don't have those deep expertise, especially in emerging and frontier markets. So that won't be our first choice.
Got it. And you mentioned, you gave a very good list of funds, and you mentioned some impact funds. People in Pakistan are familiar with IFC and CDC, but a lot of the names were, I'm sure, new to us. Any idea about the minimum investment ticket size for these funds? And secondly, you mentioned that there is some interest in Pakistan, and I saw on your deck that there are a lot of Africa deals. So where do you think, how ready are these funds ready for Pakistan, and then what's the level of appetite for them?
Ali, they are very ready for Pakistan. So some of the Nordic and Scandinavian funds in particularly really want to invest in Pakistan, and they've got a reasonable track record already. So if you look at, for example, FMO, which is a Dutch fund, they have been investing in some of the microfinance institutions. If you look at Nordic funds or Scandinavian funds, they have invested in the past alongside other DFIs, especially on the renewable side of business. And they are very open to investing more in Pakistan. I think another example I would say is Responsibility and Ascion. I think the general feedback, as I mentioned, what I've been getting over the last few years, Ali, they don't find enough bankable project. They don't get approached by the companies from Pakistan for whatever reason, and I don't know what the reason is, but they get approached a lot by the Indian companies or Indonesian companies. I think it's a lot to do with the understanding of these DFIs to a certain extent, who does what. So I will definitely suggest that people who are looking to raise capital, they do more research, especially on the DFIs and impact capital. And again, if we can help, then we'll be happy to help. But I can say you for one thing for certain, the appetite is there.
Well, that's very good to know. There's another question, again, clubbing two questions together. You spoke about venture debt. And you already had a slide, Alex touched upon, the preferences why somebody should take venture debt over equity. There's a question about that. And there's another question that, if for businesses which are impacted by the pandemic, is there what are the debt financiers, how are the debt financiers treating that? Are they becoming more flexible? Is that like a force majeure on the contract? Is there anything in the SDJs which help businesses which have taken debt right now to renegotiate or get favorable terms?
I'll take the second question first, and the first question I'll let Alex answer that. Generally, what we are seeing across the emerging and frontier market on the debt side, that either the government schemes or the banks or the lenders themselves have been very conscious of the fact that because of the COVID crisis, the credit strength of number of companies have deteriorated. So as a consequence, a lot of the debt providers are giving some sort of relief. I'm not saying concession, but some sort of relief to the borrowers. And that's across the board. And I think there have been certain moratorium that were given in Pakistan as well, and India has followed that suit as well. I think the moratorium is now running at 9 months, where the certain companies or certain sectors don't have to repay debt, both principal and interest. So broadly in emerging and frontier market, a lot of banks and the government are giving some form of moratorium or relief to the borrowers. Now that depends on the company and which stage of the life cycle the company is at. Also one thing pertinent to note is that a lot of the development financial institution, including the countries itself, have doing the COVID response. And the COVID response is largely geared around the SMEs and MSMEs who have found themselves in a very sticky positions because they don't have the access to the capital. Their cash flow have been severely hampered, and they needed a bit of a breathing space to take them through the crisis. So a lot of these COVID response funds have to a certain extent helped. And a lot of these COVID response funds, Ali, don't necessarily lend directly. They normally will have the other financial institution or intermediaries, which they use to then support these MSMEs and SMEs. So there is, again, I'm not very familiar with the lay of the land in Pakistan, i.e. in terms of the development financial institutions, whether they have tied up with certain SME banks or certain microfinance institution and have provided the COVID response money or guarantees. But this is definitely, if the company in question is in Pakistan, I would definitely ask question from the banks whether they have got access to COVID relief funds. The first question, if I can ask Alex to answer.
Please, can you repeat the first question again now? Because I got a bit lost with your response.
So it was exactly this which is on the slide, that comparison between debt versus equity. I know you've already spoken a lot about it, so maybe you can quickly summarize this.
So when to choose? I guess the question is when to choose debt versus equity. It's a very, very broad question, and it depends on the type of business that we're looking at. So broadly speaking, the more and more debt that you want comes towards the the more mature you get, the more debt a company might look to raise, or a larger percentage of debt in terms of all the cash that they're raising. So earlier stage businesses, very early stage businesses should not be looking at debt. But when it comes to optimizing capital raising rounds, so let's say you're doing an equity round and you want some subset of that to be debt, it's not a question that's particularly easy to answer without really doing a deep dive into a business. So you'd look at how much, I guess, essentially the cost of equity to all of the shareholders and investors in the business versus the cost of debt and versus the probability of failure of such a business. So over 2 to 3 years, you would optimize for how much debt that you needed in the business to maximize everybody's returns within the business. So this goes back to my point of having a very robust financial model. The only real way to answer the question of how much debt you should have in an equity round is by doing a deep dive on the financial forecasts. And when it comes to the other options, if you're a more mature business and, like I said, you're looking to extend your runway for a better valuation, it's easy to reach out to venture funders and speak to them about what it is they're looking for and what stage of businesses they invest in. And a lot of funders, investors will upfront say that they only invest in profitable businesses. So if you've had a larger cash burn than one has expected over a period of time, and you know that you really are generally very close to profitability or hitting some very key milestones, then debt becomes a very interesting option at that point, if that answers the question.
It certainly does. Thank you. Thank you for those insights. There are a lot of people which are appreciating your presentation and saying that it's very informative, and I echo their comments. They're asking for a copy of the deck, and I think this video, video of your presentation as well as the deck would be available on Park Launch's website. The final 2 questions, and again I'm clubbing 2 questions. They're asking about, have you looked at e-mobility solutions as a sector? And the second question is that, does copper exploration, does that come into impact sector? And if it does, have you looked at it?
So again, I'll pick up the copper exploration. We can definitely look at the mining side of things. The copper itself is a very interesting sector, and I'm a big fan of copper as an investable kind of commodity, and we do a fair bit in commodities generally. This is something that I would like to explore. What this gentleman has in mind. We'll be happy to speak.
That's wonderful. And Ali and Alex, maybe it would be great if you can share your details. I think it is on the last slide. So if you can put it over there, this presentation on the last slide, so people on this call who want to contact you can use those contact details.
Yep.
And
again, if I just want to make sure that they are, if they aren't, then we will add that before you circulate the deck.
That's perfect. Thank you so much.
Sorry, Ali, just one thing. I haven't tackled the e-mobility question. Yeah.
So I think e-mobility is an interesting example. Obviously, it's a large sector, but e-mobility in particular is an example of some of the businesses, not all of them, of startups that have incredibly overblown valuations, as I discussed earlier. So particularly the Chinese e-mobility businesses that have scooter and e-bike services across the world. So these are businesses that burn huge amounts of cash, and many of them are very, very far from profitability. I think e-mobility as a sector is incredibly interesting, but it is a tricky place to raise money simply because there's been so many businesses with huge amounts of capital that have failed in the last couple of years. So it's a great sector, but it's incredibly important here to look at these alternative sources of capital. So particularly impact and SDG alignment, how it really helps people and how it really affects change. You can get funding from a lot of these parties, but I'd say it's normally important to stay away from pure play venture capital funding because there hasn't yet really been a good exit or a good story in the e-mobility space in the last couple of years. If that answers your question.
Thank you. This was a very informative session, and we had a good Sunday evening learning about it. And as I said earlier, I think these sectors are extremely important for Pakistan, and it's really great to hear from you that these funds are interested in investing in some of these sectors, which could have a massive impact, a social impact on the changing lives of people in Pakistan. And as you highlighted in your presentation, the asset class is growing quite strongly and it's already become quite relevant and quite important asset class for businessmen and entrepreneurs to be aware of. So thank you for your insights. I'm sure a lot of people would want to reach out to you, and we will share the contact details to them.
Ali, thank you very much for your time as well and for moderating, and thanks everyone, and please feel free to reach out to us. The deck that we will share, we will have our contact details.
Perfect. Have a good evening.
Thank you very much, everyone.
Lovely weekend. What's left of it. Take care.
Thank you.
Bye.